Hello everybody, hope you're all doing great. This is your nandakumarkv at iLeadTax.com welcoming you on yet another interesting topic on US taxes. And today we are going to know 7 things that you should keep in mind when filing your personal tax return, that's Form 1040. Let's dive into this exciting topic without any further delay. Okay, the foremost important thing that you got to know is what is the tax return that you're going to file. So normally when you file the tax return, they say you have to file either a 1040 or a 1040 NR. So when you are filing your tax return, there are 3 types of tax returns that you must be keeping in mind. The first thing is Form 1040, which is filed by US citizens or resident aliens. The next one is Form 1040 NR, which is for US non-resident aliens. And beginning 2019, IRS has launched a new form, Form 1040 SR, which is for senior citizens aged 65 and above. And there's something very important for the departing aliens, so normally known as the sailing permit, or the people who are leaving US for good, or if they are expected to come back again. There's something called as Form 1040C, which is US departed alien income tax return, which they need to file with the IRS before they choose to step out of the US. And it is also served as a compliance certificate from the Internal Revenue Service. So I told you that there are resident aliens, then there are non-resident aliens, and then there are citizens. So you must be knowing who is a citizen or a national, somebody who belongs to that land, or somebody who is born in the United States, or somebody who becomes a lawful permanent resident of United States is treated at par with US citizen or national, and they file a 1040. Now, for non-immigrants, people who come outside of US and establish their principal place of abode, which in simple terms is residency in US. They come to US for work or for business purposes and they try to settle down there. Now, what happens to those people? How do we determine for tax purposes if they are resident or a non-resident? So let me explain you with this chart here. As you see here, the word resident, you see 8 letters in the word resident, and there are 8 situations that you must be knowing in order to become a resident alien for the tax purposes. So let me walk you through each of the situations one by one. The first one, as you see, it is somebody who is born in US or who is a US citizen or a green card holder. And I told you before the start of this session that somebody who is a US citizen or a green card holder or somebody who is born in the US will be filing a Form 1040. So by default, he is treated as a US resident alien. The next situation that you see is somebody who is married to a US citizen, and most of you must be knowing the stories of people getting married to a US citizen and how they acquire the citizenship and all. So somebody getting married to a US citizen, and if he or she also gets US citizenship, and they also qualify to be resident aliens for tax purposes. The third option that we see here is somebody who has resided on non-immigrant working or dependent visa for at least 183 days. So if you are somebody who is on H1 or H4 or L1 or L2, example I'm saying, or TN visa, and you've been working in the US or you've been residing in US for at least 6 months, that is 183 days in the calendar year, that is beginning from Jan 1st to the December 31st, even then you're treated as a resident alien for tax purposes. The fourth situation here, as you see, is somebody, if you have been on F1 visa and you have been studying in the US for more than 5 years, even then there are rules wherein you can be categorized as a resident alien for tax purposes. The fifth situation that you see here is something called as substantial presence test, wherein your past residency is taken into consideration. So if you have been in the current tax year for at least 31 days and in the last 2 tax years, the previous tax year and the previous tax year, based on certain mathematical calculations, if you qualify to stay at least 183 days for the current year, previous year and the previous year, then also you are treated as a resident under the substantial presence test. And how to calculate the residency under substantial presence test? Please submit your details to our office, and our iLead tax expert will be more than happy to determine if you qualify to be a resident under any of these 8 situations. And the next test that you see here is the first year choice test. So if you are somebody who has come to US for the very first time and you've been in the US for at least 31 days and you qualify certain 75% test, and for the next year if you're going to stay in the US for at least 183 days, which is like more than 6 months, even then you can be treated as a resident alien under the first year choice test. Okay, finally we talk here about the non-resident spouse election. So the first one, as you see there, if at the end of the year you as a taxpayer are resident, so if you're somebody on H1 or L1 and you've been in US for more than 6 months and your spouse has joined you very recently, she's on H4 or L2 and she's been in US for less than 6 months, so there's a way how you can treat her as a resident too, by making a married filing joint election. And the other option is, if at the end of the year both of you, taxpayer and the spouse, are non-resident, but for the next year you stay in US for more than 183 days and you qualify to be a resident as in a first year choice test, even then you are treated as a resident for tax purposes. So these are the 8 situations in which you can be treated as a resident alien for tax purposes, and if you qualify to be a resident under any one of these 8 situations, then you qualify to be called a resident alien for tax purposes, and you will be filing a Form 1040 as your personal tax return with the IRS. Now the point arises, who is a non-resident alien? So a non-resident alien is somebody who is not a resident under any of these 8 situations. As simple as that. The next important thing that you got to look for is what is the filing status that you will be selecting on the tax return. So as you see here in Form 1040, you see that there are 5 filing status. You see single, you see married filing jointly, married filing separately, head of household, and then qualified widow or widower with dependent child. And though more than one filing status may apply for you, you got to select only one that is best for you. As you read these filing statuses, most of the titles appear to be pretty self-explanatory. So single is somebody who is unmarried, who is either a bachelor or a spinster at the end of the tax year, or who is legally divorced or separated under court of law. Next one, married filing jointly. Married filing jointly in case taxpayer and spouse, they both agree to file a joint return. So in India, husband and wife, they have an option. The only option that is available for them is to file the return separately. But in US, they encourage the couple to file the return together, wherein they report all their incomes, all their expenses together, and they claim the tax deductions also. So married filing jointly is something wherein the husband and the wife, they file the return together. And even for married filing jointly purposes, even if the spouse has no income or low income, still she is qualified to file the tax return with you under married filing jointly filing status. Okay, the next one is married filing separately. Now here, the married filing separately status is used when both taxpayer and spouse, they choose to be independently or separately responsible for their taxes, or in case if they are in very high income groups, and filing separately is much beneficial than filing jointly. Ask our iLead tax expert and he will tell you if you got to file your taxes with your spouse jointly or separately, and at some times you may have to file a joint tax return for federal, and for state you may have to file it separately. So please talk to our tax expert to know if you have to file your taxes jointly or separately. The fourth filing status that we see here is head of household. So if you are somebody who is taking care of your family and supporting your dependents' living expenses of more than 50% for the entire year, and they reside with you for more than 6 months for the entire year, then you are the head of the household. So just because somebody is father or he has given birth to somebody does not necessarily make him as the head of the household. Only when he does his responsibilities right, he is called the head of household. The last filing status that you see here is qualifying widow or widower with a dependent child. As you see, if someone lost his spouse, his or her spouse, and is left with a dependent child, and the widow or widower, the surviving spouse, is supporting the kid for more than 50% of his or her living expenses, and the kid has been with her in the US for at least 6 months, then he or she is qualified to claim the status of qualifying widower with dependent child. The third thing that you got to look for is whom can you claim as dependents on your tax return. So while we discuss the filing statuses of the 5 different filing statuses, you are also entitled to claim tax benefits for the dependents that you support. Now, if you are a married taxpayer, you have to remember that spouse is never your dependent. Whether they accept it or not, they are not your dependent, they are your better half, and they are called co-taxpayer or co-applicant on the tax return. See, in order to claim any person as a dependent on the tax return, there are 2 main tests that you got to keep in mind. One, you got to support that person for more than 50% of his living expenses for the entire year. The second thing, he got to be a resident. I mean, if he is a citizen, of course, he is the lawful permanent resident of that nation. But for tax purposes, as I said, any one of the 8 situations, the word resident has 8 letters. I told you about 8 situations in which somebody can be treated as a resident. So he must be a resident alien for tax purposes. In other words, if that dependent has stayed in US for at least 183 days in the tax year that you are filing the tax return, then you can claim that person as a dependent. Now, dependents basically are into 2 categories. As you see in this chart, you have qualifying child and you have qualifying relative. Now, qualifying child, as you see, you have kids here, own, step, adopted or grand, like the own children or the stepchildren or the adopted children and your grandchildren. For some people, the brothers or sisters are also like kids, and IRS encourages you to claim them also as kids on your tax return. And as you see in the chart, if somebody is a full-time student, if somebody is studying, he or she is pursuing some education, then the age limit is up to 24 years. I mean, if you're claiming a kid, their age must be below 19 years. And if somebody is pursuing a full-time education, their age must be less than 24 years. And in case they are differently abled, physically or mentally handicapped or challenged, then there is no age limit. And under the qualifying relative category, you can claim your parents, in-laws, your brothers or sisters who are above 17 years of age, or in case they are full-time student, above 24 years of age. Under the qualifying relatives category, you can claim your parents, your uncle, aunt, or brother or sister above 17 years, or kids above 17 years, or full-time students above 24 years whom you support. But the only thing that you have to keep in mind is that their annual gross income must be less than $4,200 for the tax year 2019. And if all these conditions are satisfied, under the qualifying child category and the qualifying relative category, then you're free to claim them as the dependents on your tax return and claim the tax benefits that you are eligible for. The 4th aspect that you got to look for is what incomes must be reported. We are filing an income tax return, so certainly we need to keep in mind what all incomes must be reported. And many people, they think that at the tax filing time, only W-2 is important. Only the wage statement is important. But if you look at this chart, it says personal tax filing is not just about reporting wage income or your Form W-2. There are so many other incomes that needs to be reported. We have just understood who is a US citizen or a resident alien, or who is a non-resident alien for tax purposes. And the point that you got to keep in mind, that if you are a citizen or resident of US for tax purposes, then the worldwide income must be reported on your tax return. And if you're paying taxes in the non-resident country, you can claim foreign tax credit or foreign earned income exclusion to avoid the double taxes. But as a citizen or resident, you're called to report the worldwide income, the global income, the income that you have made across the globe. And for US non-resident, only the income that is earned in the US is taxable. So if you look at this chart, there we have listed some of the income items here, like interest income. So in case if you have received Form 1099 INT, all these source documents, all these income documents, including your W-2, your interest documents or dividend documents, majority of all the source documents you must have received by Jan 31st of the next tax year. So supposing you're filing your 2019 tax return, the due date for you to receive your Form W-2, your interest document, dividend document and other brokerage statements and all is Jan 31st of 2020. Now, if you look at this chart, it refers to the other incomes that you must be reporting on your tax return: the interest income, Form 1099 INT, dividend income, Form 1099 DIV, retirement income. So in case you have income from IRAs, pensions or annuities, you must have received a Form 1099-R from the payer. And then you have social security benefits, you get Form SSA 1099, and then you have your state and local tax refunds. So state and local tax refunds are also taxable in case you have claimed itemized deductions last year. So as we go through this video, I'll tell you what are itemized deductions in a while. If you have received any unemployment compensation, Form 1099-G you must have received. And then if you are an independent contractor, you must have received Form 1099 MISC. And if you have any properties, or if you are a writer, author or singer, you must have received royalties or rent, and that also gets reported on Form 1099 MISC. And if you have income from shares, stock or securities, you must have received Form 1099-B. Of course, if these shares are from your employer, then that income must have been reported in your W-2, and if the company has given you any stocks or shares or stock options, it will also be reported on your Form W-2, and you must be having the corresponding stock option document from your employer. And finally, you see there income from pass-through entities. So pass-through entities are S corps, S corporations, partnerships or limited liability companies with 2 or more members. So these companies are pass-through entities because the entities do not pay any tax. The company or the corporation does not pay any tax, but the tax burden is passed on to the members, and that's why it is called pass-through entity. So if you are a member of S Corp or if you are a partner, you must have received your Schedule K1 from the entity, from the company by Jan 31st, and even that must be reported on your tax return. Now that you have reported your incomes, the next most important thing is how do you reduce this income? When you're filing your taxes, the most important thing is how much refund am I getting is what many people are curious about. So how will you get more refund if you had more withholdings, or how will you pay less taxes only when you reduce your taxable income? So the next element that we are going to learn is number 5, what deductions to claim on your tax return. Now here, when we talk about deductions, I talk about reducing the taxable income, reducing the tax liability, and as most of you know, I am also a tax trainer at iLead Tax Academy, which is focused on creating employment opportunities for the Indian students, and it is also focused on creating earning opportunities for US dependent visa holders, who most of them are H4 people who feel that H4 visa is a curse, and they feel so disappointed and down because of the lack of earning opportunities or employment opportunities in the US, but they can always volunteer for the service or for the education that they have. So we encourage those people to become enrolled agents, the highest tax experts in the USA. It's the highest tax credential directly from the US Department of Treasury, that is Internal Revenue Service. So we educate them to become enrolled agents, and they act as our franchisee, our word of mouth, without any investment. So if you are somebody, or if you know somebody who is on H4 or who is on a US dependent visa, we encourage you to train them at iLead Tax Academy and make them an enrolled agent, the highest US tax expert, and serve the community, especially the Indian community in the USA, with all the tax and financial planning needs. Having said that, so when I teach people the US taxes at iLead Tax Academy, I always say that you got to remember 5 things to reduce the taxable income or the tax burden of a client. What are they? A, B, C, D, E. So as you see in the chart, A is for adjustments, B is for benefits, C is for credits, D is for deductions, and E is for exemptions or exclusions. So I've categorized what can reduce the taxable income or the tax liability of a taxpayer into these 5 categories. And let's get started to understand what are these 5 categories which are important and which are going to reduce your tax liability. And if you watched the video this far, I encourage you to please like this video, and subscribe our channel and click that bell icon next to it so that you get all latest tax videos and tax updates. Okay, so before we understand the adjustments, let me show you on the 1040 where the adjustments appear. So if you look at 1040, you see line number 8A here, you see adjustments to income. So this is the amount that comes from Schedule 1. Now the question is, what is Schedule 1 now? So let's go and see what Schedule 1 is. And Schedule 1, as you see, the title says additional income and adjustments to income. So here all the incomes that we discussed a while ago, the incomes get reported. In some incomes they get reported in 1040, and the other incomes they get reported in Schedule 1 additional incomes. And the adjustments piece that we are discussing now, which are also known as above the line deductions or above the line adjustments, which reduce the taxable income, are seen in part 2 of Schedule 1, as you see right here, adjustments to income. And you see some adjustments here. So let's try to understand what these adjustments are. I love to give acronyms and I want you to remember this very easily. So if you are somebody who is a student pursuing enrolled agent and part 1 talks about individual taxes, it's also important for you for examination. And if you're a client also, what adjustments can I make to my income? Remember that there are 11 adjustments that you can make. The word adjustments has 11 letters in it. ADJUSTMENTS. 11 letters and then 11 adjustments. Let's learn them one by one. The first one that you see here is educator expenses. So if you are somebody who is a teacher or a professor, then you get $250 each as adjustment to income, which is called educator expense deduction. And if both husband and wife, taxpayer and spouse, both of you are teacher or professors, teaching is the only profession that teaches all other professions. So if you are somebody who is a teacher or professor, then you get $250 each if you put in at least 900 hours into teaching at any institute or a university in the United States. The next deduction that you see is business expenses of performing artists. So if you are a performing artist, I'm not talking to those husbands who perform before their wives when they are late home or they come in a different form. I'm talking to a performing artist. So if you're into singing, dancing, or you're into arts or any creative thing, and if you've incurred any business expenses, then you can claim them as performing artist business expense deduction. The next one that you see there is health savings account. So if you're putting some money into health savings account with a bank or a custodian or any financial institution for health saving purposes, and if that is a self coverage, then you get $3,500 as deduction, and if it is a family coverage, then you get $7,000 as deduction. The next one that you see is moving expenses, and in case, and this is now restricted only to armed force members, the officials of the US Army. So if you are somebody who is in the US Army and you keep moving from one regiment, one segment to another regiment, then, and if you have incurred any expenses, those expenses can be claimed as moving expenses. The next one is self-employment tax deduction. So for those people who are employees, you will see two major deductions in your payroll, that is Social Security taxes and then Medicare taxes. Social Security taxes are deducted at 6.2%. Medicare taxes are deducted at 1.45% of your total wages. And the employer is also required to make the equal contribution of 6.2% and then 1.45%. So together 7.65% is made by employer, 7.65% is made by employee, and together it is 15.3%. But what happens if you are a self-employed person and you are the employer, you are the employee? Then you are responsible for paying 15.3% on the income you make, on the earnings you make. Don't you think it's bad? Even IRS thinks so. And that's why it gives 1/2 of that 15.3% as deduction when you report those earnings and taxes on Schedule SE. And as a self-employed person, if you are contributing for any retirement through Simple or SEP, which is like Saving Incentive Match Plan for employees, Simple Retirement Plan, of course it doesn't sound simple, but it's called as Simple Retirement Plan, and then SEP, Simplified Employee Pension. If you are investing into these retirement plans, then also you qualify for a deduction as an adjustment to income. The next one is penalty on early withdrawal of savings. So normally when we put the amounts into fixed deposits, It is for a fixed tenure. It is for a fixed period. You're not supposed to withdraw that money. But in case you withdraw the money before the agreed tenure or agreed period, then there's a penalty that is levied, and still IRS gives you a deduction for that penalty. And alimony paid. So in case there has been a legal separation during the year, and if you have paid any alimony paid is claimable as adjustment to income, and any alimony received is reportable as income. Then the next one is IRA deduction, individual retirement account. So there are basically two types of IRA which is very common for individuals: a traditional IRA and the next one is Roth IRA. Normally the traditional IRA is something that gives you the deduction. Roth IRA is focused mostly on the wealth maximization, the people who are in the high income groups, and in case they have a higher income, it is good for them to invest in Roth IRA, because in a traditional IRA, though they contribute, they cannot get any tax deduction. So in case you are contributing for a traditional IRA, you get deduction up to $6,000 based on your annual or adjusted gross income. And if you are somebody above 50 years, then you can make additional $1,000, which is also known as catch-up contribution, in which case you can make up to $7,000 as contribution to a traditional IRA. And the last two deductions are primarily for the students. So if you have taken any education loan to pursue your education in the United States and you pay any interest on such educational loan, that is called a student loan interest deduction. And this could be for you, your spouse, or for your kids, your dependents. And the amount of interest that you can claim is $2,500. And the last one is tuition and fees deduction. In case you have paid any tuition and fees for education in the US for yourself, your spouse, or for your dependents, then you can claim up to $4,000. I hope you like these 11 deductions under the head adjustments to income, and if you find it interesting, just copy this link and share it with your loved ones. Okay, next we talk about the benefits. I put it for the benefit of my students actually, and also for the clients. So the first one here, I talk about non-resident spouse election. I have discussed this in the residential status also, where I said the word resident has 8 letters and there are 8 situations in which a person can be treated as a resident. I'm repeating the same thing here again because it is a tax benefit. So most of the people who come to US for the very first time, they think that they have to file only their taxes. Even though the spouse has come to US, they do not know that they can claim the spouse also on a tax return. And most of the times, the way it works is first the husband goes to US, he settles down the things. So let's assume that he has been in US for more than 6 months, and then he brings the wife, at the time of Thanksgiving or something like that. So normally the husband has been in US for more than 6 months. And in case if she has been in US for less than 6 months, there is a way how the husband, the primary taxpayer in our case, let's assume so, can elect to treat the non-resident spouse, who is his wife, also as a resident for tax purposes, and they together can file a joint return. And to file a joint return, it is not necessary that the spouse has income. The very fact that they are married, she is qualified to be in his life and also on his tax return, and they are qualified to file a married filing joint return on Form 1040. And the next benefit that you see here, what if both are non-residents? In case both taxpayer and spouse are non-residents at the end of the tax year, but if they are residents for the next tax year, in case in the next tax year they stay for more than 6 months, even in that case, there are chances how you can elect to be treated as a resident alien. And if you get into a free consultation with our tax expert by calling 530 hi iLead 530-444-5323, they will tell you if you can qualify to claim your non-resident spouse as a resident and file a joint return with her. The next is a tax treaty benefit exclusively for the Indian students. So by law, the non-residents are not allowed to claim standard deduction. But if you are somebody who is a student from India who is on F, M, J or Q visa, then according to Article 21(2) of the US-India Tax Treaty, you are qualified to claim standard deduction on your Form 1040-NR. When you file your tax return, you are qualified to claim the standard deduction. Contact our office to check if you have satisfied all the conditions that are needed to claim this deduction. And the last one, here I have put Rica Taxes. So in case you are a student, you must, and if you are working, You must not have been subject to FICA tax deduction, which is Social Security taxes and Medicare taxes. So if you are somebody on F1 and you've been doing some odd jobs, and if you have a W2 or something, and if your employer has deducted FICA taxes, you should ask your employer to refund them, because you must not be paying FICA taxes. But in case you don't get a refund from your employer, we can help you get a refund of those FICA taxes. Okay, so let's get into C, that is credits, carryovers and carrybacks. Here I have listed few credits. Now before we discuss the credits, you need to understand why do we call them credits. So are you going to get some benefit? Absolutely yes. So whatever we discussed earlier, if you remember ABCDE, I reiterate again, ABCDE, adjustments, benefits, credits, deductions, and then exemptions or exclusions. Adjustments are something which reduces your taxable income. So credits are something which reduces your tax liability. So if you ask me what's more beneficial, whether a deduction or a credit, I would always say credit. So here also the word credits has 7 letters, and I have grouped the credits into 7 categories. See, I'm doing all this so that your understanding is eased, and when you file your taxes, or if you are somebody who is a student at iLead Tax Academy, you also know that there are 7 types of credits. 7 types of credits. So as a taxpayer, when you are paying taxes, you should make sure that you don't miss out on any of these credits which are put in these 7 categories. And I always tell my clients that whenever you are talking to a doctor, lawyer, or an accountant, and if they're asking you too many questions, do not get annoyed, because they ask you questions so that they can save you or they can serve you. And we as tax accountants are here to give the best of our expertise. So let's look at this chart. So the first category, I have put it for kids. And when you see here, they get child tax credit. So if you have a Chintu, Bunty, Bubbly who are below 17 years of age, for each such kid, you will get $2,000 as the child tax credit if they have a SSN and they are resident alien for tax purposes. Not only that, in case, after all the adjustments and all, if your tax liability is 0, still you have an option to get the child tax credit as additional child tax credit, and it is up to $1,400 because it is a refundable credit. Even if you owe no taxes or low taxes, still you will get the extra child tax credit as refund. The next one is child and dependent care expense credit, and as most of you know, in today's world, both the husband and wife, they do their best to make the ends meet, and if they both are in employment, or one is in full-time employment and the other one is pursuing an education, full-time education, or one person is in business, the other person is in employment, and one person is in business or employment and the other spouse is differently abled or unable to take care of himself or herself. In such case, if they are putting their baby or their dependent into a daycare or a medical care, then whatever is that dependent care expenses, they can claim up to 20 to 35% of the expenses that they incur on taking care of their dependents as a credit on the tax return. And the next one is adoption credit, and you see the amount there. It's $14,080 per child. So do you understand now why celebrities adopt so many kids? So for every kid, you get $14,080. And the last category of credit for the kids, we have put it as credit for other dependents. This is for those kids, you can say, the kids of the non-immigrants who do not have an SSN, or in other words, if they have an ITIN, instead of the child tax credit, they get credit for other dependents, which is $500 per kid. We have made a separate video on ITIN. So if you have subscribed to our iLead Tax LLC channel, you will see a video on 9 things you got to know about the 9 digits ITIN. If you need more information on ITIN, I encourage you to please go and watch that video. The next category of credit, I've categorized it under the head education. So if you're somebody who is into education, you're a student, it could be taxpayer, it could be spouse, it could be your dependents, could be your kids or anybody who is into education, then you can get 2 types of credit. Any of the 2 types of credit. One is an American Opportunity tax credit, and the other one is a lifetime learning credit. Life is full of learning, and I love this credit, lifetime learning credit. It's full of life. Even at iLead, we came up with the name iLead because I learn, I educate, I act, and I develop. And that's how, if you see L, we have put L as learn. And whenever I see this credit, lifetime learning credit, it reminds me that we should always be learning, because learning breeds earning. So if you're somebody who has invested into education, you get American Opportunity Tax Credit, and you also get Lifetime Learning Credit. The limits are put there, $2,500 for American Opportunity Tax Credit and $2,000 for Lifetime Learning Credit. And the next category of credit is under the heading Health, and this is a premium tax credit. So if you're somebody who has purchased health insurance or something from the marketplace, then you get this premium tax credit. And the fourth category, I've put it under the head savings. So if you are somebody who is saving for your retirement, in the sense that if your income is low, but still you have made an effort to contribute to your 401k or your IRA or any other qualified retirement plan, government encourages that saving habit and it gives you retirement savings contribution credit. The next one is residential energy saving credit. So if you are somebody who tries to save energy, you don't want to waste energy, so you try to use some solar equipment, some wooden furnaces, so you don't want the electricity to be consumed. So government encourages that thought, that action, and it gives you a credit called as residential energy saving credits. Talk to our experts to know what items qualify for residential energy saving credit. And the last one is electric vehicle credit. As you see, it's electric vehicle credit. So here also, if you're trying to save the environment, that's why I put the heading savings. If you're trying to save the environment by reducing pollution and the gas consumption, then the government encourages that initiative and it gives you electric vehicle credit. And the next category of credit, I have put it as income. So the earned income credit, normally it's called poor man's credit. So somebody whose income is low, government gives him earned income credit based on the different filing status and based on different members in the family. The earned income credit changes from person to person. And the next one is foreign tax credit. So in case a person has income from US and he also has income from India, he's paying taxes in India, and because he is a citizen or resident, the worldwide income is taxable, so he reports the Indian income even on the US tax return. So there is double taxation that is happening. The same income is getting taxed in both the places. So to avoid double taxation, foreign tax credit is a relief to that particular income. Next one is Amt Alternative Minimum Tax. So if you're somebody who has enjoyed too many adjustments, benefits, credits and deductions from the government says, while we appreciate all these deductions, we expect, or rather we anticipate, that you pay some minimum tax, and that is called Amt. And if you're somebody who paid alternative minimum tax in any of the past years, then it gives you a relief too through minimum tax credit. The last one is carryovers and carrybacks. So if you are somebody who claimed foreign tax credit and you still had some unused credits left over, or your foreign tax credits were not fully claimed, so you can either carry back or you can carry over. And that's how I put all these credits under these 7 categories. I hope you like these 7 credits. Okay, so all these 7 categories of credits that you have seen is claimed on Schedule 3 of Form 1040. So as you see, Schedule 3, it reads the heading additional credits and payments, and you see Part 1, it talks about non-refundable credits and all the different types of credits that we had discussed, and of course Part 2, it talks about other payments and refundable credits. So let's get into the next part of this section, D Deductions. Okay, let's talk about D now, deductions. And deductions, if you are an individual, the most important deduction that you need to look for is, should you be claiming standard deduction or an itemized deduction? Now, what's the difference? Standard deduction is a fixed amount of deduction that is allowed to you based on your filing status. So if you take a look at the Form 1040, you will notice that on the left hand side, when you see that the standard deduction for single or married filing separately is 12,200. For married filing jointly or qualifying widower is 24,400, And for head of household, it is 18,350. So we just discussed a while ago what are the 5 filing status. We understood the meaning of it, and the standard action for each of these filing status is this. And the next one is itemized deductions. When we say itemized deductions, these are the actual expenses which are incurred by the taxpayer. So let's take a look at the Schedule A, because itemized deductions are claimed on Schedule A. So when you see Schedule A, you see that there are heads of expenses like medical and dental expenses, taxes you paid, interest you paid, gifts to charity, casualty and theft losses, then other itemized deduction, and the total of all these 16 lines comes on line number 17, which is again taken to line number 9 of Form 1040. Okay, on Schedule A, let's try to understand what are these medical and dental expenses. See, medical and dental expenses are those expenses which are incurred for taxpayer, which could be you or your spouse or your dependents. Now, normally one of the very common medical expenses is maternity expenses. So maternity expenses for spouse. At the time of maternity, if mother or mother-in-law or somebody is coming to support her, you can claim their travel expenses also, their insurance, their accommodation costs, and if such person has been with you for more than 6 months during the tax year, you can also claim them as a dependent on the tax return. And the most important thing about medical and dental expenses is that it should be something that is prescribed by the doctor. It must not be cosmetic, or it must not be something outside the medicine outline. And you can claim medical expenses only which are in excess of 7.5% of your adjusted gross income. Next, we see taxes you paid. So as you see the taxes you paid on line number 5, you see that there are state and local taxes or general sales tax, state and local real estate taxes, your personal property taxes, and all these taxes, they call it as SALT, state and local taxes, and they are restricted to only $10,000. And any other taxes, example foreign taxes or something, you can claim it on line number 6. Then you have interest you paid, and as you see interest you paid section, you see that on line number 8 you have home mortgage interest and points, and mortgage insurance premium, and home mortgage interest not reported to you on Form 1098, the investment interest and all. So to cut the long story short, if you have a home and you're paying interest for it, and there are ways, if you have a home outside of US also, you can claim home mortgage interest and the points. Points are also known as loan origination fees or processing charges or whatsoever. So all these are part of itemized deductions. The next one is gifts to charity. They say give and it shall be given unto you. So if you're a person with generous heart and you do charity, whether in cash or in kind, you can claim it as a deduction on the tax return if you made such donation to a qualified charitable organization. Speak to our tax expert to understand if the donations that you have made qualify for a tax deduction. And the next one is casualty and theft losses. So if there is any casualty that has taken place and the US government has declared that it's a federally declared disaster area, then you can claim any casualty and theft losses on the tax return. And then finally you see other itemized deductions. So in case you have any gambling losses or hobby losses or any other miscellaneous expense, that can be claimed under other miscellaneous deductions. And the total of all these lines from line number 1 to 16 comes on line number 17, which is the total itemized deduction. And then this is taken to Form 1040, line number 9. Okay, the next type of deduction is estimated tax payments. So just like how you have advanced tax payments here, you have estimated tax payments in the US. So if you have made any estimated tax payments, even they qualify as a deduction. Next one is a capital loss deduction. So in case you have any long-term capital loss or short-term capital loss, whatever is the nature of capital loss, try to deduct it first. Not try, you have to deduct it first against any capital gains, and whatsoever is the remaining loss, you can deduct it against the ordinary income like wages or something like that up to $3,000, and anything remaining you can carry forward. And the next one is business loss deduction. So if you are somebody who is into business, so if you are somebody who is having a rental real estate loss, you can claim up to $25,000, which is also known as passive activity loss deduction. talk to our tax experts to see if you qualify for that $25,000 deduction on your rental property. The next one is the net operating losses. So in case your business resulted in any losses, we can claim net operating losses up to 80% of the income for the next year. So in case you have any net operating losses from the past years, so in the current year you can claim the losses up to 80% of the income that you made in the current year. Anything remaining can always be carried forward to the successive years. Okay, let's take a look at exemptions and exclusions. So as you see here, I've put the first one as interest from municipal bonds. So if you have received any interest income from municipal bonds, it is exempt from tax. Of course, you will get an interest income statement form 1099 INT, but still the income is exempt from tax for federal tax purposes. The next one is if you are a US citizen who is living outside of US, and if you have made any income outside of US, then you qualify for foreign earned income exclusion. And also if you have received any foreign housing allowance, you also qualify for foreign housing allowance exclusion. So if you are a US citizen who is currently outside of USA and you're making some income outside of USA, please talk to our tax expert to see if you qualify for a foreign earned income exclusion. Foreign tax credit also can be claimed, but claiming a foreign earned income exclusion is a deduction against the income, whereas claiming a foreign tax credit is a deduction against the tax liability. So talk to our tax expert to identify whether a foreign earned income exclusion is beneficial for you or a foreign tax credit is beneficial for you. Next one is capital gains exclusion on sale of your main home. So if you are somebody who owns a house and who has used the house for your residential purposes for 2 out of the last 5 years, then you can exclude up to $500,000, which is like $500,000 from your capital gain on the sale of that main home or that residential property. And next one, I don't think most of you would be involved. This is not for everybody, but just in case, if you have made any gifts, if you've given any gifts up to $15,000 are exempt. Of course, not your spouse. And then estate tax. Estate taxes, if you're somebody who is paying estate taxes with a gross estate value up to $11.4 million are exempt from tax. Talk to our tax experts if you need any help on will, gift and estate tax planning. Okay, I think we have so far covered the complete flow of the tax return. Okay, I think I've walked you through all the schedules. I've walked you through 1040. I've walked you through Schedule 1 and Schedule 3. But there's something called as Schedule 2. Let's take a look at Schedule 2. Now, as you see, Schedule 2, it says tax and then other taxes. So the first part, it has alternative minimum tax. And I told you a while ago, AMT, alternative minimum tax, it's like you avail too many adjustments, benefits, credits, deductions, exemptions, exclusions, and all the tax benefits that's conferred by the IRS. But still, the IRS may say that you may have to pay some minimum tax based on some tentative income calculations and all. So that minimum tax is called AMT. Normally, AMT comes to high income taxpayers or the people who avail too many deductions or credits. So if you're somebody like that, please talk to our tax expert to see how he can help you reduce your AMT. And the next part that you see here is other taxes, and in other taxes you see self-employment taxes. I think I told you self-employment taxes. So if you're somebody who is self-employed, you got to pay the employee share of taxes and the employee share of taxes 15.3%, and half of it is given to you as deduction. And all these taxes are reported on Schedule SE. And then you have line number 6, additional tax on IRAs and other qualified retirement plans. So when you invest into an IRA, you're not supposed to withdraw. You're not supposed to withdraw until that particular tenure. So let's say 59.5 years of age, or for 5 years in case of a Roth IRA. But if you withdraw, then it is called a premature distribution or an early distribution, and you will be subject to regular tax plus 10% additional tax. Talk to our experts to find out how you can withdraw money from an IRA and avoid that 10% additional tax. Next one you see on line number 7, household employment taxes. So if you are somebody who watches Dilip Kumar movies, you must have seen Ramu Kaka. So if you have any employee within your home to take care of you, your family and all, who helps you in the household chores and all, and you pay salary to that person, then you got to pay household employment taxes also. And now you understand why most of the taxpayers do not have a maid when they are in US. And then you have a repayment of first-time home buyer credit. So if you're somebody who bought a house in 2008 or 9, in those years, government was giving a $7,500 a refundable credit in 15 years. So they gave straight $7,500 credit, and they said that they'll be repaying every year $500. So it refers to that. So if you have just stepped into US, please ignore this line. So the total of all these credits, it is known as total other taxes, and this flows into line number 15 of form number 1040. Okay, let's take a look at page 2 of 1040 here before we get into our sixth question. Okay, you see 1040 page, I think we have seen page 1, and now we come to page 2. Page 2, we see the taxes and all, and then you see the refund information. I'll come in a while. Now before we come to refund, let's go to question number 6. Question 6 is, what else do I need to keep in mind besides tax filing? So I've put it in this chart. The first one is FBAR, Foreign Bank Accounting Report. So if you are somebody who has more than $10,000 outside of USA in a foreign financial account, it could be bank, it could be insurance, it could be stocks, mutual funds, or whatsoever. If you have more than $10,000 outside of USA, you are required to file a report. It's a kind of statement. It's not a tax return. And this is applicable only to US citizens or residents. US non-residents are exempt from this. Next one, FATCA, Foreign Accounting Tax Compliance Act. In case you have more than $50,000 or $75,000 outside of USA, then you are required to file Form 8938 with the IRS. This is also a reporting statement only for the people who have more than $50,000. Next one, ITIN. I think I told you ITIN is for those people who do not qualify for an SSN. I have made a separate video on ITIN. So if you want to claim your dependents on the tax return who do not have an SSN, you've got to apply for an ITIN. Please speak to our tax expert so that they can help you on how to apply for an ITIN. Next one, extension filing. So in case you've made all the calculations, everything is done, but you cannot file your tax return before April 15th, which is the regular due date for filing the taxes, please talk to our tax expert so that they can file a free extension and get you an automatic 6 months extension so that you get additional 6 months to file your taxes, in which case you will have time until October 15th to file your taxes. Next one is amendments. So if after watching this video you felt that you missed claiming certain deductions, I have given you so much content here: ABCDE, adjustments, benefits, credits, deductions, and exemptions. And after watching this you felt that you missed something in any of your last 3 years tax returns, we request you to please submit your last 3 years tax return for a free evaluation, and our tax experts will check for any additional refund possibilities or for any compliance aspects. And if there's anything that we can do to help you, to fetch you some more money, or to make you compliant with the IRS, we would help you or guide you to file a revised tax return, which is nothing but a US amended tax return on Form 1040X. Speak to our tax expert today to see if you missed claiming any of these deductions on your previous year tax return. You have 3 years time to amend your previous year tax returns. Okay, next one, you see estimated tax penalty. See, estimated tax penalty is if you have not paid at least 90% of the taxes before the end of the year in the form of withholdings or whatsoever, then you will be charged with estimated tax penalty. And last, finally, is W4 planning. I'm sure your current year taxes are taken care by your tax consultant, which could be iLead Tax LLC also. But in case if you have not planned for the next year taxes, we encourage you to please have a free tax consultation with our tax expert so that he can advise you on how to have less withholdings every month. See, don't try to get high refunds at the time of filing. What does high refunds mean? It means that for the entire year, you've given an interest-free loan to the IRS. You have had too many withholdings from your pay stub, from your monthly pay. In fact, please schedule a call with our tax expert and see how you can increase your monthly pay rather than giving an interest-free loan to IRS or state and then waiting desperately for a refund. Please plan your tax withholdings properly by talking to our tax expert. Okay, give yourself a pat in case you were able to watch all these 6 scenarios so far, 6 things that you have to look for when filing your tax return. So we are on the last slide, on the last aspect that you got to look for, the 7th one. Should you e-file or paper file your tax return? Why do we file the tax return? Most of you would say refund. I would say that whenever you file a tax return, three things happen. 1, you get a refund. 2, you pay taxes. Or 3, nothing happens. No refund, no due. Now, in case you want to file your tax return, the most fastest and the secured way is always e-filing. And for the e-filing to happen, you need to sign something called as Form 8879. You can print it, sign it, or you can electronically sign it. There are so many options today. You can digitally sign it also, and then submit to your tax preparer. And it's a confirmation that you're authorizing him to file your tax return. And make sure that because of the so many identity thefts happening these days, you protect your identity. In case if you want any additional protection, you can put identity protection pin also, so that only you know it, and only when you give that identity protection pin to your tax preparer, he can file your taxes. Now, for you to get the refund, you can either get it by check or by wire transfer, by electronic deposit. And the most fastest way, you know it, it's through wire transfer. And for that to happen, you need to provide your bank details on the tax return. And what is it that needed? As you see, you need to provide the account number, the routing number, and the type of account. Is it a checking or savings account? If you see the Form 1040 here, it asks for all that information. And in case you owe the taxes, you need to submit the bank details here too, and give a date before April 15th, on or before April 15th, when you want your funds or the taxes to be deducted from your bank account. And next you see third-party designee there. So in case you want us, your preparer, to discuss this tax return with the IRS in case of any audit or notice or whatsoever, you must authorize them to discuss your tax return with the IRS. And last, you see the signatures there. So if you're filing the return manually, then you will have to manually sign the tax return. So if it's a joint return, both you and your spouse have to sign it. And if you're applying for an ITIN for a kid who is a minor, still one of you can sign the ITIN application form. And the last one, you see the paid preparer details there. Just furnish the paid preparer's information. Of course, whomsoever you're filing with, they will give the information there. And that's it. Just make sure that the preparer is somebody who is a qualified professional. He should be either a CPA or an enrolled agent who has been filing taxes and has a decent credibility. There are so many online portals today available in the market, and I make a very humble request not to file with any online portal that you see. Yes, today with the advent of technology, we have to follow the online portals, but just because it is free and just because it is cheap, I very strongly urge you as a tax professional not to go with any tax consultant who is not a qualified professional or who does not have any knowledge or experience in filing taxes. Choose your tax preparer wisely. So if you go to IRS website, irs.gov, and type choosing a tax professional, it will tell you if you're filing your tax return with a qualified professional or a certified professional or not. Please check out their qualification and their credentials on the IRS directory of federal tax return preparers, and make sure that you're giving your tax return into safe hands. So much data theft and abuse of tax calculations and tax refunds happening. I just hope and pray that your return lands in the safe hands. Okay, finally, once you have submitted the return, it's time that you await the receipt of your refund. And for receiving the refund, if you have electronically filed the tax return, it takes 7 to 21 working days. If you have filed it manually, it takes 4 to 6 weeks. And if you have filed an amended tax return, it takes 8 to 16 weeks. So in case if you have to file an amended tax return, we urge that you file your amended tax return soon, where it takes longer, almost like 4 months for you to get that refund. And just some minor observations, just make sure that your name, address, your date and phone number, occupation, signatures, they're all correct, because sometimes the e-filing gets rejected. Instead of Sharma, if you put Varma, the return gets rejected. So just make sure that your name is right and the numbers are right. Okay, I hope you liked watching this video. If you have liked this video this far, I request you to please give a thumbs up. Please like this video. Please share this video with 3 people and please engage them in a conversation. Please let us know what you liked about this video, and if you want us to make a video on any tax challenges that you have been struggling with, please write to me at nandakumarkv@ileadtax.com, and I'll try to make a video on it and present to you so that it is not just useful for you and also for your friends and the community at large. And until we catch up with our next video, before you hit the close button, I request you to hit the subscribe button and click the bell icon so that you will get more interesting videos on the tax topics that you may be interested in. Thank you very much for being this far, and I wish you a very happy tax filing at iLead Tax LLC, and I wish you all the very best in also becoming an enrolled agent, the highest US tax expert through iLead Tax Academy. All the very best.